Good morning, welcome and thank you for joining us today. My name is David Edgar and I'm your Regional Sales Manager here at Wealthtime and your host for today's session. You'll see on the screen shortly some of our learning objectives for today. What I'm going to do next is introduce you to what I'll be covering today and a panel of experts shortly. But before we get started, there is a small housekeeping point that I need to cover off. It's the only part of the session where I need to read it word for word. So if you can bear with me for the next 30 seconds. This webinar is designed for financial professionals and the information provided in this webinar is for general guidance and informational purposes only. It does not constitute financial tax or legal advice, and while we aim to ensure accuracy, the content reflects our understanding at the time of delivery and may be subject to change. Advisors should always refer to official sources and apply their own professional judgment when advising clients. Neither presenters nor the organisation accept liability for any decisions made based on this material. Okay, so now that's out the road, we can get started. In today's webinar, I'm delighted to say that we're joined by Tony Wickenden and Claire Trott from Technical Connection, alongside Phil Wickenden from Ad Lucem. Tony is the founder and Managing Director of Technical Connections, and they are a specialist tax, legal and financial planning support business that has served the financial services sector for over 40 years. Claire is a director at Technical Connection who has over 25 years of experience in the pensions world. She's worked closely with advisors throughout her career, having been one herself, and is known for helping advisors make sense of complex pension topics and offering clear, practical guidance. Last but not least, we have Phil with us today. Phil is the founder of Ad Lucem and has spent 17 years helping financial service firms understand what's really going on in the market and what advisors and consumers truly care about. Having led successful research businesses, we engaged with Ad Lucem to carry out some detailed research on tax year end and tax year start challenges and opportunities experienced by consumers. And today he will be sharing some of the discoveries and insights with yourself. So that's the starting lineup. And now I'll quickly run through what we'll be covering today. But before I do that, just a wee reminder, if you have any questions, you'll see a wee Q&A tab on the right-hand side of your screen. If you could put your questions there as we go, and at the end of the session, we'll answer them for you. So, what will our panel of experts be talking and taking us through today? They will look at setting yourself up well for tax year end and tax year start and why it's such an important time to engage with your clients. We will look at the key budget changes that need to be factored into tax year end and tax year planning. We will discuss what your clients are feeling and doing during the busiest time of the financial year. We'll then cover off a summary of the key pension planning strategies to consider at tax year end and tax year start. And finally, we'll look at the tax year end essentials for investors and business owners. So the good news is, as we're about to pass you on, we're recording today's broadcast. So if you're unable to stay for the full session, don't worry, you'll receive a link which you'll be able to replay this. So without further ado, I'm going to pass over to Tony and we can get you started. Tony, over to you.
Thanks, David, and morning, everyone. We are in a tax planning sweet spot, aren't we? That time between the anxiety that comes with completing your tax return and then even greater anxiety paying your tax on the 31st of January and the end of the tax year. And you're bombarded, your clients are bombarded with encouragement to review their tax planning horizon to see that they're making the most of their allowances and exemptions. So that's no different to any other year. But what is different this year is we have experienced, and we're about to experience a lot of tax change. And when I say a lot, you'll know I mean a lot, and we'll be covering some of that in some detail, especially the stuff that's relevant to tax year end and tax year start planning. And there's not much of it, actually, there isn't. Now, you know, because you'll do it every year, you'll be talking to your clients about ISAs and pensions and making sure you use the allowances up, and then CGT planning and income tax planning and inheritance tax planning. But with all of that, and you'll know this every year, and you'll experience it, and your clients will, there is that point of, yeah, but is it worth doing in practice? And you and them will have to carry out a kind of cost benefit analysis, because some of the stuff, frankly, is good in theory, but not that worth doing in practice. What a way to start a webinar on tax year and tax year start planning. But there is an awful lot that is definitely worth doing. That practical aspect, what comes with end of year planning is, and Phil will talk much more about this when I hand over to him, is that anxiety that comes with having left something to the last minute, and that can often lead to stasis and you end up doing nothing. That's a really, really big thing. And then of course, when you do nothing, then you've got a bit of regret and you feel a bit of an idiot because you didn't take the steps that you should have done and other people may have done. So having a very practical bias to this is really, really important, and hopefully we'll keep that in mind when we get into the real detail. That point I mentioned around this year being even more important, it being even more important to get to grips with tax planning and make sure you cover everything before doing that practical analysis, really is driven by those budget changes. And just to remind you of them, and I know we've done sessions on this before, so I'm not going to labour these points, and we'll bring them out more in the planning. Remember, it's just incredible when you add them up that just over the last year or so, we've got 2% added to dividend taxation, and that's happening from the 6th of April this year. Another 2% added to savings tax income, to the taxation of savings income, and also to property income from 2027. Claire's going to talk a lot and with a lot of detail and importance around those pension tax changes and inheritance tax that hit on from the 2027 tax year. Let's also not forget we've got the cash ISA changes coming down the track from 2027. That's going to be a big year. And we're moving into that one last year before it all happens. Another this year, tax year end change, a kind of advised by opportunity for VCTs with that rate dropping from 30% to 20%, the initial tax relief rate that you get when you go in. Qualifying disposals to employee ownership trust also changing. I'll talk a bit more about that when I talk about business owners. And the business relief limits for inheritance tax hitting from April 2026. I know the level's gone up to 2.5 million, but it is still hitting. And we've had all those CGT changes that we've experienced in the not too distant past, but we're living with them now with those higher CGT rates and of course the continuing low CGT exemption. That is a lot, isn't it? It's an awful lot. And I think that LAFA principle is really coming into play, that people are seeing that tax change is changing their behavior and they're more open to and more just that they just want to consider how they can reduce tax, because so many more people, as you know from that whole thing of frozen tax allowances and fiscal drag, are paying tax and paying more tax across the board. So having a look at how that is affecting how your clients act and are thinking of acting, what their anxieties are, what their challenges are, and what their aspirations are at this time of the year in particular. And remember, it's so important to look ahead as well as just looking back and doing that last minute stuff. That's that research that David referred to. And I'm going to hand over to Phil to say much more about that and our discoveries.
Thanks, Dan.
Right.
Yeah, hello everybody. Thanks for joining. So tax year end has a funny habit of doing something odd to otherwise sensible people. I mean, just look at Declan Rice on the weekend. Normally, the model of dependability, somehow giving the ball away. And I think when you look at the replays, you can see quite clearly what's driving that isn't the pressure of the title run-in. It's allowances. Apologies. Look, we all know the deadline. We know roughly what's on the menu. And I think, yeah, year after year, we still end up with at least some clients rushing decisions late in March. Admin teams under pressure. And that lingering sense, I think, on both sides of the fence that, you know what, this could have been calmer or cleaner and frankly better. So as David was mentioning, we wanted to look under the bonnet, not at the rules or allowances, but at that experience from the client perspective. So understand behaviorally what's going on. So we asked 1,000 advised UK adults with an average of 350k investable assets. what tax year end actually feels like to them, what slows them down, and frankly, what would make action easier. I think the story that comes out of this is very clear. Tax year end doesn't stall or falter, if you like, because clients don't care or because they're super forgetful. I mean, they may well be super forgetful, but it tends to stall or falter because the process makes action feel a bit risky. And the key bit here is that confidence isn't what it could be, even within an advised audience. So let's have a look at that confidence gap. Post-budget tax year, as Dad was saying, tax year end is increasingly emotional before it's technical. And we just look at those stats there. 53% told us that they feel more worried about tax than a year ago. 47% said that they're uncertain about rules and allowances. And when we roll all of that up into our tax year end confidence index, average score, bear in mind this is advised clients, average confidence score on this particular issue is 45.7 out of 100 for advised clients. So this isn't apathy, that's hesitation. And I think hesitation has a very predictable behavior attached to it. Delay. People who aren't sure that they're doing the right thing don't act earlier. They wait. They look for a moment when it'll feel clearer. And they often find that moment, I don't know, around the 31st of March or whatever. What's striking, which is in the report, which we'll be publishing as well, is the advisor advantage. Clients currently and on an ongoing basis engaged with their advisor score meaningfully higher than those who have used advised in the past or do so intermittently but aren't currently engaged. And I think that what that shows us is that proper ongoing engaged advice doesn't just deliver better recommendations, as you know, it gives people psychological permission to act. And I think that's really, really important and will be increasingly going forward. So I'm not going to get into Hazel and AI conversations here, but in terms of that core facets of what's really going to be defendable going forwards, it's all around that. But that's for another webinar on another day. So if you take one thing from today, is this: tax year end, let's think of it less as a deadline and more of a confidence intervention, if you like, or at least a mini confidence intervention, to be a touch Americanized. I'm latterly watching, far too late watching Succession at the moment, so that's probably what's influenced that. But what's driving this low confidence then? Because it's important to understand that. If we're looking at what those drivers are, which I think we've got on the next slide, 3 worries stand out consistently, and they all score within the same intensity when rounded up or down slightly, a couple of decimal points, to 4.3. The 3 things are: I don't understand which rules apply to me, I'm scared of getting family decisions wrong, and I'm worried I'll mess up the admin, are the 3 core things that are underpinning things. And here's the point: these aren't I want a clever strategy worries. They're I'm not sure what I'm doing worries, or I'm not sure what I need to do worries. They're a different kind of worry. So the job isn't just explaining, it's making action feel safer. And that's quite key. It's about making it clear what can be changed later and what can't, keep flexibility visible, and I guess swapping the big decision for small next steps wherever possible. Because I think the more pertinent, or permanent rather, a choice feels, the more clients procrastinate, even when they've got money, they have experience, and even when they know that they should act. That's the key point. Which brings us to the late rush problem, which we've got quite clearly in front of us here. Now, what this is showing is that last year, we've got these stacked left, the more orangey hue is looking at when people acted in terms of tax year end last year, and then in light when they are and when they're planning to act this year. The key story here is that over half of clients did most of their activity in March or April. Nearly a quarter crammed it into the final week, and still a significant minority left it to the last couple of days. And here's the uncomfortable bit. This doesn't really improve with good intentions either, because even this year, 1 in 5 are still planning or expect to do most of it in the final week, even though that happened last year, and even though they planned for that not to happen again. So it's that intentions versus action thing. But what that underlines for us is that this late rush as such isn't bad clients, naughty clients, slap on wrists. It's what you get when confidence is a bit fragile and decisions feel high stakes. And operationally, we know the outcome of this, compressed time, higher admin risk, important decisions made in arguably the least forgiving window of the year. But the good news, time for good news, is that if behavior is structural, then the fix can be structural too. So what that means is that we don't need louder or more persistent reminders. We kind of need a better runway. In order to construct that in the most productive and effective way, we need to probably understand some of those barriers to action again. So if we pull on to the next slide, what clients say actually stops them, and appreciating that there's a difference between say and do, but what clients say actually stops them acting sooner. The first thing they mention is the lack of time at 28%, and I won't read out all the others. Fear of doing the wrong decisions, unclear priorities, administrative burden. The key thing here is that on paper, lack of time comes first. In practice, lack of time is often what uncertainty sounds like when it's wearing a sensible coat, if you like. Because if you're confident, you find time, you can find time. If you're unsure, you find reasons, excuses, deferment, procrastination. And I think that's why the best lever is, I think, quite beautifully unglamorous, really. It's around safe friction removal. Because in the research, the most helpful things are consistently three things, if we were to be a tad reductive. It's first, a short tax efficiency health check. Second, it's a simple checklists that make priorities obvious. And third, it's advisor prompts that reassure as much as they inform, essentially. So it's not urgency, it's not last chance, it's reassurance and regret reduction. So the stat, I think, that should change how we think about this cycle is when we talk about regret. I've had a few. I will stop there before I launch into either Sid Vicious's version or the original. Maybe that's a debate point for afterwards, which you prefer. The next stat, if we look at the next slide here, is that 74% of clients report at least one regret from the previous tax year end. And interestingly, critically here, the most common regret isn't I paid too much tax. It's I left it too late and I felt rushed. So it's not a knowledge problem, it's a process problem, as we've kind of alluded to already. But the key thing is that regret's also really, really useful if, and it's a big if we handle it well. Handled badly, as Dad already mentioned, it becomes guilt and avoidance and all that kind of stuff. Handled well, it becomes a reset moment, or at least an opportunity for a reset here. Because I think the first month after 6th of April, the intention is there. Our research showed that in detail. Clients tell us that they plan to open or top up an ISA early, set up regular savings, do a tax audit, review pensions, all the good stuff. The intent's there, but as I mentioned earlier on, nearly 1 in 5 already admit that they'll probably put it off, which isn't a great start. So what can we do about this? Right, so what clients value most, if we look at the next slide here, in this particular period, and this is key. So what clients value most from their advisor at this particular time of year is clear priorities, reassurance, simple explanations, administrative help, and flexibility and access. Now, that's a very different hierarchy to tax optimization theatre per se. Clients want you to cut through that complexity. Tell them what matters first. They want to feel safe, that they're not making a mistake. They want plain English, importantly, that they can repeat to their partner. And also they would love the paperwork pain to be a bit smaller if possible as well, wouldn't we all? In other words, though, make it clear, make it doable, and make it safe. So let's finish, if we can, round on to the last slide with something that you can actually use. And this is modeled around those the behavioral economics of what is most likely to land well with most clients, accepting that every client's different. So, of course, and your clients better than we do. But broadly speaking, behaviorally speaking, Phase 1, December to January, invite clients to do a short tax health check. So it's more, let's keep your options open, rather than we must maximize everything. And this is the point where you can, from a practical perspective, pre-collect what you'll need later, while there's still time. Phase 2 in February, it's a one-page priority checklist, 3 bullets: what matters, what's optional, what needs a decision, and agree realistic cutoff times for execution, cash, paperwork, platform time, all that stuff. Phase 3 in March is execution month. So, earn your keep by making admin lighter where possible, pre-filled forms, delegated steps, clear confirmations, that kind of stuff. Phase 4, early April, is really about that, or should be, ideally, last mile workflow, not that kind of last minute heroics, if you like. So it's about triaging what's left, simplifying the options, protect the process. And then finally, post-April 6th, and I think this is probably the underused bit, sending reset notes that turn that regret into momentum, ISA early, regular savings, tidy ups. For clients, I think that mean well but delay, book that short follow-up, then whilst, intentions warm. So I think do some of those small, practical, but behaviorally aligned things, and tax year-end stops being drama and starts being system. Earlier structure, calmer execution, fewer errors, better outcomes, and importantly, a stronger client experience, which is really what this all boils down to. So thanks very much for that. I'm going to pass you over to Claire now for a take on pension perspective.
Lovely. Thanks, Phil. I'm going to take a quick step back and just touch on where we are in the world of budget, because I think that's quite important. We did have some things. I personally thought this year's budget, or last year's, so this tax year's budget, was going to be a super quiet one for the world of pensions. And yes, it wasn't as exciting as the 2024 budget, where they sort of tore everything up and said, pensions, IHT, we're going to have to deal with all of that. But they did make some additional tweaks. So I think that's the really important thing when we're talking about pensions and IHT here, is we're not there yet. So just be mindful whenever you're making any changes or you're doing anything, that they are still putting the legislation through. That's a really important point, that we saw a report from the Lords on the pensions legislation, on the IHT proposal for that, and also for the BR stuff. And the Lords were quite negative about this. I don't think they were negative enough to actually change the mind of the government, but it was a call for evidence, and there was a lot of people that put things in. Myself, I wrote them a massive essay saying all the things that they got wrong, obviously, and they did take some of it into account, and they did put some of it into their recommendations. The one that I think is probably the most comical, and it was a suggestion of mine, is that they shouldn't launch this until we actually have a functioning pensions dashboard, because personal representatives are going to really struggle to understand pensions, to find pensions, to have all of them in place. I think that's a real driver for the advised clients, so your clients out there, to understand where all their pensions are. So that was a recommendation that the Lords have made, that we shouldn't be putting the pensions and IHT stuff into force in 2027 if we don't have a functioning pensions dashboard by then. I think we'd be pushing our luck to actually expect that to happen. They also did say that actually all the legislation should be in place by April 2026 to give personal representatives time to understand it, the support material to be written and to be available to personal representatives, and for pension scheme administrators to have all their processes in place, down pat, so they're ready to be able to deal with this in April 2027. I don't think we're there yet. This hasn't quite gone into the Lords. We were still on committee stage and report stage the other day when I checked. Forgot to check this morning. Sorry, everyone. But it's definitely not quite there yet. And there's still some tweaks that need to be done, because there's still some vagaries in there. So there were some additional changes in the budget, which I think we just should worth noting, that there is the ability for personal representatives to hold back monies from beneficiaries now for up to 15 months or until the IHT is paid. And that's the government panicking that they've given free rein for pension benefits previously to be paid out and the beneficiaries to pay the IHT. They've realised the beneficiaries could get the pension scheme money, do a runner, and not pay the IHT and cause all sorts of problems. So they've given personal representatives the ability to restrict access to that. They've also said that they will, once the account is closed, the IHT account is closed and everything is finalised, if you find another pension scheme, you don't have to reopen the account. So that can be dealt with separately. So a big win. But the big surprise came in the budget, and one that I think you will need to start thinking about sooner rather than later, is the changes to salary sacrifice. So with a restriction on salary sacrifice to £2,000 a year, it's not till 2029. And a few people have said to me, we might have a new government by then. Do we think that it will actually come into force? Well, they're saying they're going to get it into legislation ready to go. So with a start date of 2029, just in case. Clearly, they're a bit worried about whether they'll still be around in time to actually put that in. So that's what happened in the budget. So nothing major, but it's just tweaks to things we're already dealing with apart from the salary sacrifice. So just looking at tax year end, tax year start, none of this is new. I think Phil referenced getting ahead of this is something we should do. Getting ahead of this is not always something we do, and also something that we find really hard to do because of the timing of information, being able to get everything together. But now is the point that you can start collating everything. But I always say tax year start, make sure you're asking the questions to get the information ready for tax year end. So it's really important when you think about tax year start, if you start putting out feelers for things like pension input amounts from DB schemes, for example, they have to provide them if you request them either within 3 months or by October, which is the legislative date. So you can get them in place. Whereas if you ask them in October, they then have 3 months to provide them. So if you ask them in April, you'll get them in October. So it's really important to think about the timing of getting things and the time it takes for schemes to be able to provide information. And we know there's a lot of problems out there with pension scheme administrators, especially in the big DB schemes. So getting those requests in sooner means your tax year end next year will be much smoother. So just thinking about those, what are we doing at this point in time? Carry forward, really, really important. What do we need to know to do a carry forward calculation? We need to know the last 3 years' pension input amounts. We need to know this year's, how much we've done this year. If at any point in those previous 3 years, you went over the annual allowance in any of those years, you need 3 years before that. So it's always 3 years prior to any excess, because that means you can work out the actual amount. Yes, of course, you can just do 4 years, but the likelihood if you've gone on excess at any point in there, then you're not going to be able to maximize it because you need to be able to do it. And get a good calculator. Just make sure you're using HMRC Do One. I wouldn't call that a good calculator myself, mainly because you can't save it. So if you do it and you go, oh, I need to change something and I want to do another run, you've got to input it all again. So I'm not a big fan. And back in the day, it was actually wrong. So when they did the split tax year, it was all wrong for about 6 months and no one noticed. So I would always suggest get one that you know and trust and use it really well. The other thing that you need to be really conscious of is when we're doing these calculations is understanding your income or your client's income, because now we have multiple different types of income we need to understand. So we need to understand our adjusted net income. Do we need to pay more pension contributions to bring our earnings below the adjusted net income? Do we need to do adjusted income and threshold income for our tapered annual allowance? And they're different figures again. So adjusted net income has things deducted, such as pensions, whereas adjusted income and threshold income, again, calculated on the same starting basis of net income, which is everything that's taxable. And then you start taking off different bits. So you need to understand what you're working with. And then on a complete flip side, we've got relevant UK income. Just for another definition, a relevant UK income is really what we call is earned income. So that's what you can get pensions tax relief on. So we use all taxable income when we're doing the calculation to work out what your annual allowance is. But when we're working out how much personal tax relief you can get, what we're looking at there is the relevant UK income, which is earnings, self-employed earnings, weirdly profits from royalties, that kind of thing. But there's been some changes over the years with those. So if you're looking at furnished holiday lets, you used to be able to include that, but the furnished holiday letting rules changed so that they're now not included in that. So there's lots of different things to consider. And so it's always good to go back to basics and work out, what am I trying to calculate? What is the purpose of this figure? So I'm using the right one. I have to say, over the last few years, since the introduction of the tapered annual allowance, we've seen so many more errors in calculations of the relevant UK income, because when we're calculating for taper, we're putting in dividends, we're putting in savings, putting in rental income. So people start calculating and including all of that and thinking I can get tax relief on that, which you can't. So it becomes really important to understand what's what when we're talking about it. Also, where do bonuses sit in? We get that last minute bonus. Most people get their bonuses in March quite often, and that can really cause some issues. And you often only get a very, very short window to determine whether or not you want to sacrifice some of that bonus, for example, or you want to put it into your pension in this tax year. And that bonus can really tip people into the issues of the 60% tax band, 63 if you're in Scotland, and various different things like that. They could mean that they're not going to get their child tax-free childcare vouchers. It could mean that they're going to get a high-income child benefit charge, for example. But you need the calculations done prior to knowing what that bonus is going to be able to factor that in and make quick decisions. So it's really important to get on and get all those details. So having that all in details at this point in time is ever so important. Again, salary sacrifice I've mentioned that is changing in 2029. So getting on and making sure you're getting the benefits of that now, as well as any matching for the client. So when we're looking at pension contributions, where's the best place to put it? Is it they've got investments in a SIP, for example, or if they've got investments in a PP that they want it separate from their employer? But are we going to lose out on any employer contributions if we don't put it into our employer's scheme? So that's all about putting money in, but we've also got this issue, and Tony mentioned it earlier, about people taking money out. So this IHT and pensions changes, I'm assuming it's going to come in 2027, whatever the Lords have suggested. To be totally honest, I think that we're well down that track, and I still think it will go ahead. There'd have to be some major issues for us not to go ahead. But we're getting up to within a year of those changes, and we all know when you're doing IHT planning, the sooner the better, generally, because you need to be able to get it out your estate. You've got timing issues. You might be investing in something that might take 2 years. You might be putting it into a trust that might take 7 years to get out of your estate, making sure you understand all of those things. So starting planning now, this tax year, sooner the better, can be really, really important. But what do you do with it? And I might leave that one up for Tony. But there are issues, there are things to consider. And actually, again, one of the big things that we're seeing at the moment is insuring against these liabilities. Putting in insurance places, whole of life plans, so that when the worst comes to the worst, that we've actually got the money to pay the tax charge, and we're not necessarily losing out on anything. But it's the simplest probably form to be able to do it. But again, there's challenges there. What are we insuring? The legislation's not in place. Making sure that we can do it, making sure that we're using the right way to fund it, and of course making sure when the money pays out it doesn't fall into the estate again and cause additional issues, because we know how hard it is to get clients to fill out all the appropriate trust paperwork on the right day with the right dates. But bear with it, make sure it's done, because if you don't do it right, it becomes a real issue. So none of this, as I said, is new. It's getting on there. It's understanding what you're trying to achieve. It's understanding where the best place to put the money. It's understanding, I think, going back just a little bit of step, is what type of schemes has your client got, because that can also impact how you're going to do it, how you're going to calculate it, what we're going to put in. For example, I've been looking at some calculations very recently about buying additional pension in the NHS for a client, and that's actually quite complex, because you have to try and work out what they're buying, how much they get. But actually going onto the NHS site and looking on there, they've got a great calculator. So I think going to schemes and asking the questions, the sooner the better, gives you that best chance of getting these things done within the timescales. So say we're getting towards the end of the year, and don't leave it till the last minute. That's my sort of price to you, because pensions, you get it wrong and it tips into the next tax year, you can have significant tax consequences of getting that tax relief and that tax contribution, that pension contribution, in the wrong year. I think it's enough of my preaching on the world of pensions. I think I'm going to hand over to Tony, who's going to preach on other things just as important.
Peace be with you, Claire. Fantastic.
Thank you.
Another tour de force on pensions. Forced to me to talk about year-end and tax year start planning for investors and then business owners. So investors first, going to consider the tax no-brainers, which won't take long. Investment income, because there has been change and there will be change on the taxation of that. Capital gains, of course, and wealth, inheritance tax and wealth transfer, and then we'll have a look at the business market. So straight into that. Obviously, the ISA and JISA conversations you will be having. If there's one thing that does tend to get done by enterprises and by advisors, is the reminder of ISA contributions. No change there, although of course we do have that change for the under 65s coming down the track. And there's some questions still to be answered around that. Watch this space, as it were, in relation to what counts as cash-like in relation to those ISAs. We already know about transfers. So ISAs, I've had a couple of questions recently around JISAs, and that was both of them to do with parents who said, is there another way than putting in a JISA because then my child gets that when they're age 18. And there is another way, and I've actually implemented one of those other ways for 2 of my grandchildren because of that request from the parent. And that is, you can do trust-based solutions outside of a JISA that can be just as tax effective using a trust to hold the money in a GIA or any form of collective. It just takes more work. So nothing new there, just a reminder that there is another solution if that's something that the client says, I'd really rather not do a JISA, even though the JISA is quite clearly very simple and very tax effective. VCTs I've already mentioned, and that is an advised by date for those clients for whom VCTs may be appropriate, taking into account risk and liquidity and all that kind of stuff. But that upfront tax relief is dropping from 30 to 20. I know the VCT companies are seeing an increase in interest in VCTs for that reason. I mean, there's always a year-end interest to use that 30% up, but it's going down to 20, so there's even more incentive to do it. I can confirm, and you know this anyway, so there's no need for me to confirm it really, but just to say that the dividends do remain completely free of tax from VCTs. It's a real benefit that maybe you don't consider when you first enter into a VCT, because you're all about that front end relief and maybe some CGT deferment. But when the dividends come through, if they do, then the fact that they're tax free, especially given, neat segue coming here, that the dividend tax rate is going up by 2% for basic and higher rate taxpayers, not additional rate taxpayers. Quite strange at one level that, but because those rates are going up, anything that produces tax-free dividends, like pensions inside the pension fund, like ISAs, and of course like VCTs, is to be welcomed and looked at quite seriously. So on that dividend taxation point, the rates are going up by 2%. Is there anything you should be doing before the end of the year? 2% for basic and higher rate taxpayers, remember. Is there anything you should be doing before the end of the year? Because, that rate goes up next year. So if I had the dividend in this year, it will be taxed at a rate that's 2% lower than it will be next year. Well, if you don't have control of the income, then there's not much you can do, really. If you do have control, and I'll just consider that when I talk about business owners, then there could be something that you could do if you think it's worth doing. But looking forward, and this is where we get to that tax year start, in that tax year start review, and the importance of it is to look ahead to next year and go, okay, dividends are going to be taxed in that way. It's a higher rate of tax. Is there something I should be considering putting in place to make the most of the next tax year? And the best time to do that is at the start of the year, and not have that regret at the end of the year thinking, if only I'd had the income flowing to my partner who's a lower taxpayer than I am, or if only I'd had my money in a JISA or an ISA for the whole of the year, if only I'd had my money in pension for the whole of the year, if I'd only had my money in a tax deferred vehicle for the whole of the year, then I would have saved that extra tax. Yeah, but you should do that at the beginning of the year. It's not something you can sort at the end of the year, unless, as I said, you've got control over the income. So looking ahead to next year, I think it is important to say it increases even further the benefit of ISAs and pensions as a place to hold income producing investments. Statement of the obvious. It brings in, and I'm going to bring in now the savings tax increase, because that rate of 2% for all taxpayers increases from the 6th of April 2027. You go, well, that's all right, because we're moving to 2026. But when you're investing for the future, you're rarely investing in vehicles that you're going to cash out of the next year. So it's important, and to Claire's point, it always works best if you take that action earlier, then to consider, how are those tax changes going to impact my investment decisions, if at all, if you are at all motivated by tax? And I would suggest you should be as part of your investment decision making, in the light of the increase of dividend taxation for basic and high rate taxpayers and the upcoming 2% increase in savings tax. So that impacts on that classic age-old bonds v collectives v GIAs, offshore, onshore, that we've wrestled with, or maybe dealt with, or expertly dealt with in the past. Well, that 2% the 2% increase in the dividend taxation doesn't make any difference to bond taxation, because dividends inside a bond are free of tax in a UK bond, free of tax in an offshore bond. So no change there. And of course, when you take the gain from a bond, it's not taxed as dividend income. Right, so we can tick that bill. But how about when you compare it with an income portfolio, a portfolio producing any dividend income that's held freely in a GIA or in a collective? Then of course that income is subject to tax if it comes out of a collective that is as to more than 60% as to more than 40% in equities, which will cover a lot of the funds, especially mixed funds, then whatever comes out in the form of income is going to be taxed as a dividend, which means that that increased tax rate will apply to you next year if you're a basic or higher rate taxpayer. Right, okay, so that does change the comparison a little bit, because it makes income producing funds a little less attractive if they're not wrapped up in a bond. But of course, that may not be the only thing that's driving growth. How about when we get to the increase to savings tax? And this is important, I think, to remember, and there's been some clarification given on this, is that how is the income tax when it's received at life fund level in a UK life fund? Well, that new 2% addition will also apply to the rate of tax that is borne by UK life companies on income other than dividend income that flows inside to the UK life fund. So it won't be 20% as it is now. It will go up to 22% from 2027. Oh, okay, so how about when you take the money out and make a chargeable gain? How's that taxed? Yeah, that's taxed as savings income. It always has been. And so there'll be an extra 2% on any tax that's borne on the gain that you take after 2027. So that would raise the rate of tax at 22, 42 and 47. But of course, if it's from a UK bond, you get a basic rate tax credit. Will that go up? Yeah, the tax credit you'll get will go up from 20 to 22%. So if you're a basic rate taxpayer, you're still not going to pay any tax on your gain. So that's good, even though it would have borne a bit more tax inside the fund. If you are a higher additional rate taxpayer, then you have an additional tax liability, but you have a higher tax credit, so it kind of neutralizes it. For the offshore bonds, of course, you have that additional rate of tax because it's still savings income to take into account, but you don't have any tax credit. So it does throw up and will require you, I think, to reassess your dividend savings tax decision making when you look at your portfolio as to whether that's better off being outside of a bond or inside of a bond. And if it's inside a bond, should it be a UK bond or an offshore bond? They're the implications of those changes for investors to dividend taxation, to the increases in savings tax. And of course, there is also an increase to the taxation of property income, yet another hit for buy-to-letters, as it were. Capital gains tax, no big change there, except that, of course, we did fairly recently experience that increase in the tax rate for both basic and higher and additional rate taxpayers, to move that rate up to 18% from 10% for basic rate taxpayers and up to 28% for higher and additional rate taxpayers. So, just keep that in mind, because that CGT exemption, which is on a use it or lose it basis, has dropped to £3,000, but it's still worth using. I mean, if you can use it and it fits with your investment strategy, then definitely use it to uplift the base value of your investments. Bear in mind clearly, as you will do every year, the anti-avoidance provisions, the bed and breakfast provisions, which will mean you shouldn't reacquire the same stock, identical stock, within 30 days of disposing of it. Otherwise, you're going to lose the benefit of that uplift that you're seeking to achieve. And the benefit of that uplift, when you consider it's only £3,000, is going to be sort of £540 for basic rate taxpayers worth of tax saving, which you get in the future, really, and £720 for additional and higher rate taxpayers. So not as big as it would have been, but that rolls up. And if you do that every year, it will reduce your eventual CGT when you eventually realise the investment, if that's the reason for you using your CGT exemption, rather than just it being there because you're making a disposal anyway. Inheritance tax, Claire's mentioned this, and that's probably the area of taxation we're getting most questions on, mostly, in fact, almost entirely related to the upcoming changes on pensions. And as Claire mentioned, the one thing you don't want to do in advising your client is, okay, go along with or advise them even on taking money out of their pension funds, where it will, after 2027, be subject to inheritance tax. And most of the discussion that I'm having, which is only my anecdotal experience, is around the tax-free cash. And if you leave it in there after age 75, it's going to bear income tax potentially when it's taken out by beneficiaries. And of course, dependent on their tax rate and inheritance tax. Then why leave it in there? Okay, take it out. But then, as Claire mentioned, it's in your estate for inheritance tax. You removed it from a frying pan into a fire, so you need to remove it from the fire as well and get some protection around that. And that's where the advisor's role is so critical. One part of the job, okay. Second part of the job, where can you put it? And then there are a number of places that you can put it to preserve it from inheritance tax and still have it aligned with the requirements of the individual investor in relation to income, access and control. The trust solutions with loan trusts and DGTs and variations on those themes are still with us. That might work. Business relief solutions, Claire mentioned on that we wait 2 years and then you're out of the woods, as it were, out of the fire, to use my old analogy. So I started thinking about wood, and wood burns in a fire. But anyway, sorry. So what are you telling them? So put it into, stop laughing. If you put it into, it's not even funny. If you put it into a business relief solution, of course they are there, and people have said, are they no good anymore? Well, they are. I mean, that limit has raised to 2.5 million from 1 million. That was a pre-Christmas gift. And even over that, you get 50% relief. So subject to those, the obvious questions around liquidity and access and risk, then they still have a role to play, of course, I think, in those solutions. We've had, I think Claire will have had 2 around, if you take your money from your pension, even though some of it may be representing tax-free cash, could that still be income for the purposes of the normal expenditure exemption? The answer is yes. But remember, you do need to satisfy the kind of 3 tests for the disposal that you then make, the transfer then you then make to qualify as normal expenditure out of income. The HMRC guidance and the practice notes are very good on this. But look at the IHC 403 to go. That's the thing you need to claim on. You don't claim it until post-death, and then it's your personal representatives. And you'll need to have a record, ideally, of income and expenditure to prove that the transfer was made on a regular basis, or at least the intention was there, very clearly noted intention that it to be on a regular basis. It is out of income, so no resort to capital, important that, and it doesn't diminish your standard of living. And also there on that income point, remember, although the pension flow definitely counts as income, if the money's coming from an investment bond, from your 5% withdrawals, 5% tax-free income or tax-deferred income, it isn't income for the normal expenditure purposes, nor is the capital element of a purchase life annuity. Annuities have come into the frame as well for where to put that money, possibly as a purchase of an annuity, and if you don't need the income, then replacing the capital that magically disappears from your estate on death with an annuity value, because it has no value on death, but it's replaced by life insurance, the proceeds of a life insurance protection policy held in trust, completely free of tax. Obviously, the rates need to stack up, and obviously there needs to be no kind of collusion. They need to be independently underwritten so that the associated operations provisions don't apply. So plenty to talk to investors about around changes that are actually new, those dividend tax changes, upcoming savings tax changes, the VCT changes, and of course those upcoming pension changes which have inheritance tax implications. And of course, using that £3,000, I said, of course, I haven't mentioned it, the £3,000 annual exemption, which of course is not quite use it or lose it. You can carry it forward to 1 year, but then you lose it. So use that exemption and have that discussion. The earlier you do inheritance tax planning, picking up on Claire's point, and it always has been the case, the better, especially for setting in place a normal expenditure pattern. It's important to get it started earlier. The proving becomes a lot easier if it's been running for a few years. It isn't taken away completely, even if you've only made 1 payment and then die, if the intention was there. But that's where noting that intention is so important. Keeping an eye on time. Right, I'll close with business owners. That dividend tax change, I said you can't do much about it at the tax year end if you're an investor. Well, you could if you're the owner of a business and you're thinking extraction strategies. And one of those extraction routes could be by way of dividend. If the tax rate's going up and you were going to make a dividend anyway, and you're in a basic or a higher rate taxpayer, then it's clearly worth considering at least making that dividend payment before the 6th of April, because you'll pay a lower rate of tax on it. I would just, with business owners, I think there's a real discussion to have, because there's been suffered some real attrition over time when you consider their extraction strategies, number one, and secondly, that if they have an exit plan, because when you look at what's happened and what is about to happen, it's been scheduled in, that increase to the rate of the reduced the lower tax rate on business assets disposal relief when you qualify for it. Well, the rate was 10%, and then it jumped to 14%, and it jumps to 18% from the 6th of April this year. Is that a tax year end opportunity? In practice, probably not. You don't go, oh, might as well sell my business then because the tax rate's going up by 4%. As someone who's done that, it doesn't actually sold a business. That is, it doesn't happen overnight. It rarely does, and you rarely get all the documentation done in time. So that's something that's happening, but it's something to be aware of. That employee ownership trust change, where you only get the ability to defer 50% of the gain, is in force now. It was announced in the last budget, but it's in force for disposals after budget day. So that and the increase in the tax rate for even if you qualify for business assets disposal relief, definitely something to bear in mind. And of course, bear in mind that it's what you're left with that really counts if you have an exit plan. And if what you're left with suffers 28% tax, which it will once you get out of that BADR scope, which is only £1 million, something to bear in mind when you're having those year-end discussions around what the plan is going forward for your business. Do you plan on having an exit? And of course, lastly, business owners are actually affected, or at least need to take into account those business property relief changes that start from the 6th of April this year, because there is a cap on business property relief. There is a cap on agricultural property relief for those of you that are farmers or have farming clients, and their value is more than £2.5 million worth of those qualifying assets. Then we're looking at 50% relief effectively rather than 100% relief. The role of protection in inheritance tax planning should absolutely not be diminished or relegated to the last thing you talk about it, because for many people it will represent a really attractive, acceptable and commercially powerful way of solving that inheritance tax problem. So here we are at the end of all of that with lots for you to do. I think if you were thinking, don't really know how to engage with my client, there is so much to engage with your clients about, because there has been so much change. You you absolutely, I think, have a responsibility to engage with the clients, which will generally end up with improved outcomes for them and probably also for you too. And I'm going to hand over to David now to see if there have been any questions.
Thank you, Tony, Claire and Phil, for that. Really informative. And really listen, for me, great to see it from a different view for Phil's session there. So really interesting. Listen, before we go in, there's quite a few questions that have come in. And before we go into that, just Tony, Claire, is there any key calls to action that you would tell advisors that they must be doing now in order to have that successful tax year end?
I'll go first, as Tony's been chatting away. Give his voice a break for a second. It's not necessarily tax year end, but it's something I think that's really important at this point in time when we're getting into that within a year of the pensions and IHT. So there's 2 points here that I really think people need to start looking at. They need to make sure they know what their client's expression of wishes are. Make sure they're up to date, because out of date expression of wishes are useless. They will cause you lots of headaches. They will delay things, and delaying things when we've got IHT to factor in causes more problems. You may also want to reconsider what they actually say when we're getting towards next year. So having those conversations, starting that conversation early, really important. And in addition to that is understanding what the death benefits actually are within the schemes, because there are so many schemes out there that are restricted, and it might drive you to transfer the money out of that scheme purely for the death benefit. I saw one the other day that was return of funds. I saw one the other day that was return of personal contributions, with the employer getting back everything that they had. Old school schemes, absolute nightmare. There's lots and lots of money in there, but people are not getting the access to it. But the one that generally comes up is it's a lump sum or annuity, or in some cases, so there's no drawdown option. And actually, if you're going to pay it out as a lump sum and it's a significant fund, you could end up with an IHT charge, a lump sum and death benefit charge, even if they're under the age of 75. So get a good handle on the death benefits to work out what you can, and then factor in your expression of wishes to try and build that in as well, so that you've got the best coverage and the best options available for the clients at the end of the day. And it might just be that the schemes they're in do not offer the flexibility required for the new world of pensions and IHT. So getting on top of that is really important.
Thank you. Tony, anything to add?
Yeah, I'll just steal a bit from Phil's session earlier and go, give your tax year end tax year start. And that tax year start part is really, really important, I think. Don't just do them and then have another conversation. I think two are very much part of the same. But give it an identity, I think, and give it a structure. Give it something that is a thing that you do, the tax year end audit, if you want to call it, a tax year end tax check, health check, whatever you want to call it. But give it a name, give it a type. people walk towards that and go, oh, I have my check. So I would definitely, even if it ends up with you still having just a structured conversation, I would say give it an identity, give it a name, get it in the diary, note it and record it. Because the Consumer Duty recording requirement is a gift to you, as it were. I mean, it's a gift to the client because they will then get their affairs looked at in a structured way, but it is also to you to prove what you're doing for your money, effectively.
Fantastic, thank you. The next part here, and just to kind of finalise up, is just a couple of questions that have come in. The first one is, Claire, it's sort of directed more at you. Are there any calculators that you would recommend?
It's a difficult one, to be totally honest, but I have to say, if you're looking at these calculators, I know I've dissed HMRC's one. It does do it all. My big issue with the HMRC calculator is you can't save it, so you can only print the PDFs at the end, so you haven't got any evidence of the calculations. But a lot of the providers out there, you know, the big names, people you know, the people you've got pensions with from all back in the day, it's in their interest for their calculators to be correct. They have a bunch of actuaries, they make sure they're right. So whatever the right one is for you. So some of them will do taper, some of them will do just carry forward, but just make sure you've got it and keep evidence. But just when you're using your calculators, a before and after is really important. Do it before that you've put any extra pension contributions in, do it after, so you're making sure you're factoring on all those different moving parts, because more employer contributions means lower taper, all of those things. So just factor all of that in.
Fantastic. Tony, probably one for you, and I think you just covered it off just recently, but again, just to highlight this, when does it make sense to start addressing the IHT issues with pensions?
Yeah, well, I think immediately, basically, I think Claire would, if you're talking about pensions making sense, you know, certainly as you're getting older, inheritance tax becomes more important to you. Early days, you're thinking, why am I doing this pension? To save tax, to save up for my retirement and all that. Inheritance tax feels like a secondary or tertiary issue to consider. But as you get older, it's really important. And with these changes that are being introduced, they are being introduced in 2027, I think, if not Claire, it might be. I think now is a great time to have that discussion because it's in the news. People are interested in it. People who have pension funds, and Claire might want to say something about this. You know, we talk generally about the inheritance tax planning and the money that's going to be left over. Of course, for the vast majority of people in the UK, there won't be any money left over because they haven't got enough in their pension to start with. But the vast majority of clients of advisors, different story, I think. Then that is very relevant to have those conversations, to make sure they take everything into account, not just rush into, I need to take it all out of the pension, pensions are no good. And I will pass to Claire here, because you'd have had more experience of these discussions, of those kind of resistance to, I just better take it all out because they're rubbish anymore. And you think that isn't all they do. It's not just about IHT. Quick word on that experience, Claire.
Absolutely. I mean, you'll tick all the boxes for what Rachel Reeves wants. What she wants for the changes to pension IHT isn't IHT. She wants income tax. She wants income tax sooner. So driving that and saying, I'll take it all out and I'll pay 45% on all of it because I want it now, will be what they want you to do. Actually, what we want to do is utilise it and utilise pensions for the purposes of pensions, which is providing income in retirement and doing it in the most tax efficient way, using all the different things Tony's talked about to minimise your tax as you go through, with an eye on the IHT at the end of the day. So it's not all about one thing, it's holistic planning, and that's what advisors do the best.
Fantastic. Listen, we've got 2 minutes left, and I'm going to try and get you to answer this one as quickly as possible. Any rules of thumb for choosing between bonds and GIAs in light of the tax changes?
Good one. Rule of thumb.
We could probably have half an hour on this, but
yeah, generally speaking, I'd go, if it's a relatively small amount of money, it doesn't really make any difference. If you're going to do inheritance tax planning, then probably it's an investment bond, but it doesn't have to be. I mean, that is the case of it. Generally speaking, it makes it easier, but keep in mind you can do inheritance tax planning other than with DGTs, with other than investment bonds, with GIs. The main thing is, I think, if there's a decent amount of income in the portfolio, so it's not just all about capital growth, then it's and you're a higher or additional rate taxpayer, it's definitely worth considering the tax deferment qualities of an investment bond. And if you pretty much know you're going to stay in the UK, then maybe an onshore bond rather than an offshore bond. That's pretty much where I am now. But you need to take all the factors into account about your tax, future tax, and all the rest of it. That's the sort of rule of thumb I would go with.
Fantastic. Listen, thank you very much for everybody. Appreciate everybody that's dialed in today and given the time. We appreciate that. We know it's important and how valuable your time is. The follow-up to this will be that you'll get sent through an email that will have all the CPD, it'll have the slides, and it'll have a copy of the recording. Some of the questions that we have, which we've not been able to get through, we'll answer those as well, and we'll attach that as well. But from all of us here, thank you. Hopefully it's been worthwhile, and hopefully it's added a bit of value to your day and going forward. Thank you.
Thanks for having us.
Thanks, guys. Bye-bye.
Okay.